So we look at supply-demand fundamentals for both UK gas and power. We've seen a lot of changes this week. Starting with the power market, we've seen another unplanned nuclear outage this week. So Hinkley Point B7's gone offline. That's taken total nuclear capacity that's offline to about 1.5 gigawatts. That's about 16% of total nuclear capacity. And what that's done is acted to narrow the minimum supply margin and make balancing the power market a bit more difficult. In previous weeks, that would have caused more of a problem because we've had really muted wind generation. However, this week we're seeing forecasts of up to around kind of an average of 4 gigawatts worth of capacity, which should mitigate the loss of this nuclear unit a little bit. Looking at the gas market, we've seen unplanned outages on the UK continental shelf. That's basically meant that domestic supply to the UK is reduced, and that's tightened the system. It has been mitigated a little bit by lower IUK demand. So the IUK is a pipeline that connects the UK with the continent. Because of the price action we've seen over recent weeks with UK prices increasing, the premium from UK prices to continental prices has increased, and that's made exports from the UK less desirable, so we've seen the demand fall away. Finally, looking at oil prices, we've seen some supply and demand fundamental changes, and we're actually looking at more downside potential going forward. We've seen OPEC's production remain really high, and on top of that, US drilling is increased. But kind of running underneath all of that, we're seeing really strong crude oil stockpiles as well as gasoline stockpiles, which should act to mitigate any upward incentive going forward. So we start off with contracts relatively close to delivery, specifically power. We've seen the day-ahead contract track to 6-month highs, and that's a result of this nuclear outage that we've talked about already. There is potential for prices to soften later in the week. As I've mentioned, wind generation is expected to increase to around 4 gigawatts of capacity, and that should mitigate the impact of this nuclear outage and could see prices soften over the short term. Looking at corresponding gas contracts, so the gas day-ahead market is softer than it has been over the last few weeks, but remains at significant premiums to the low seen earlier in the year. The main reason for that is, although we've seen significantly reduced injection into storage following the Rough announcement, we've seen really strong exports to the continent, much higher than we would do in a normal year, and that's where a lot of this excess gas has been going, and that's prevented gas prices falling as much as potentially anticipated. Looking at seasonal prices, again, following the Rough storage announcement, there was a lot of volatility, and over the last week or so, prices have really begun to fall away and get back to the levels before that Rough announcement. At the moment, they are approaching a key technical support level, and we could see prices push up against this level over the short term. Looking at the trend in the market, it's still definitely trending upwards for both UK gas and power. However, oil prices are trading counter to that and are continuing to soften at the moment. So that poses some downside potential for UK gas and power prices going forward, because if crude oil continues to soften, that's potentially going to drag seasonal prices for both gas and power lower. As I mentioned earlier, we're seeing gas and power prices approach a key technical support level, and prices could push up off that level going forward. So customers looking to trade a fixed price contract, I'd make sure you hold at the moment. Look out for this turn in the market, but make sure you've definitely got your route to market identified so that when prices do turn, it's a quick process for you to get in there and get your fixed contract agreed. For customers with flexible contracts, it's down to your current hedge level. For those customers who haven't traded an awful lot, I'd definitely treat this downturn in prices as an opportunity for you to increase your hedges. However, if you've got quite high cover already, there's not all that much incentive to increase your hedge, as the fundamentals looking forward are uncertain. There's a lot of upside risks, but there's also downside potential. So if you're in a view of trying to achieve the best possible price, it might be worth leaving a small portion of your volume to the day ahead, especially looking at winter 16, because although we've seen Rough storage restricted, there's a definite plausible scenario where our capacity through pipelines can meet our demand during winter and could see day ahead prices outturn cheaper at delivery.